The U.S. private credit market is projected to grow from $3 trillion at the start of 2025 to nearly $5 trillion by 2029. Private credit is lending by non-bank financial institutions to businesses that take place outside of the public markets.
There are so many advantages to private credit. There's the speed, the flexibility, the reaching companies that haven't really been reached before.
Private credit typically provides loans to companies that are otherwise unable to obtain them through banks or public debt markets.
Private credit has been driven by the fact that the banking system has been on its back heels since the global financial crisis.
Regulations put into place after the 2008 financial crisis discouraged traditional banks from making many types of riskier loans.
So the cost of doing business for the banking system rose dramatically, and that then pushed lending outside the banking system into many different places, including private credit.
Traditionally, private credit firms are funded by institutions that don't need quick repayment, such as insurance companies and pension funds.
The private credit funds, because they have gotten so big and growing so quickly, they're now expanding outside of the insurance companies, the pension funds, the endowments, the sovereign wealth funds as a source of funding. They're going retail, and they're trying to sell their funds to you and I as individual investors.
Investors in private credit collect higher interest rates than they would in other debt investments. However, unlike bonds and public stocks, investments in private credit are inherently illiquid and can't be sold quickly for cash. Private credit also lacks the transparency of the regulated debt markets, which trade daily on exchanges and require borrowers to give material updates. So when Wall Street comes calling with a fancy new investment, should you answer? Here's what to know before participating in private credit. Private credit was once a niche corner of Wall Street. Now it's becoming mainstream. The Trump administration has taken steps to expand access to alternative investments like private credit. This includes an executive order directing federal regulators, including the SEC, Department of Labor, to consider regulatory changes to allow alternative investments to be offered in workplace retirement plans.
It's allowing you and I to participate in this fast-growing and up to this point lucrative area of investing.
Retail investors' allocations to private market assets is projected to reach $2.4 trillion by 2030.
The big concern there is that retail investors typically need some liquidity, and so they're trying to come up with vehicles that offer more liquidity to investors. So we're starting to see private credit ETFs.
But private credit investments are illiquid by nature. That means when it comes time to sell, it's unclear how quickly investors can fully cash out.
When you do that, then you recreate the problem of a mismatch in the funding source and the loan itself, which is ripe for a bank run type event.
If suddenly there's a run, like people panic, much like they did in '08, if you have that type of withdrawal activity, that's a problem because you're going to work through your liquid stuff very quickly, then you're into the illiquid stuff. And that's where the problem begins. Like, how do I get rid of this? Like, you're going to have to either gate it, and you know what gates do. Once a fund or anything gets gated, that creates more panic.
It's very critical that we have good regulatory oversight, real guardrails here to make sure that these investors are protected, because at the end of the day, if they're not and there's failures, this is going to come back on taxpayers.
In February 2025, State Street and Apollo launched a first-of-its-kind private credit ETF. Although ETFs are typically only allowed to invest up to 15% in illiquid investments, the SEC said that in this case, private credit would generally range from 10% to 35%.
The SEC is really stepping back from its own rules on liquidity in ETFs. The regulators just don't want to interfere with this market in any way, and that is a choice that they have made, but the consequences might be bad.
The rapid growth of private credit and its recent entrance into the retail investing world means that private credit has not yet really been tested, sparking anxiety about what could happen in a fraught economic climate.
If the economy actually stumbles, if we start losing jobs and unemployment starts rising, consumers start to pull back, it's in that environment that private credit equity will get stressed. It has not been stressed at all in its existence, and it will be stressed. And then the question is, how will it navigate through all of that?
The concerns are that this is a market that is extraordinarily large and that is reaching more and more businesses, and yet it's not a public market. And so what that means is oftentimes you have a private company borrowing from private parties. There's no public disclosure. There's no disclosure of financials to a broader set of parties.
The opacity of private credit means that in a downturn or crisis, it's possible that investors might face deep losses.
We're not entirely sure if the valuations are correct. And so are we going to know whether there are signs of trouble early, or are we going to know a little bit too late?
Uncertainty around the quality of some private credit ratings is growing, raising the question of whether the risks are underappreciated. Bloomberg reported that the SEC is investigating whether Egan-Jones, a leader in private credit ratings, has been, quote, exerting improper commercial influence on its rating procedures. This could impact insurers who need the rating to be able to invest in private credit.
The double-edged sword of private credit is, on the one hand, if they really are the sole lender or one of the main lenders, they have really strong incentives to monitor for problems. But by the same token, if they really are the one on the hook for all of this, they do, in fact, have incentive to try to disguise risk.
The lack of disclosure in private credit can allow lenders to delay the recognition of problems until they are undeniable. Bankruptcies in private credit can happen quickly and with little warning, as we saw with home improvement firm Reginato in November 2025.
Renovo, which was marked at par on most people's books, suddenly just written straight down to zero because there's no bid offer. You don't know what it's worth until something happens.
Once one private equity credit firm pushes a firm into bankruptcy, others will follow very rapidly.
That could mean a wave of defaults of American companies, increasing the risk that an economic downturn morphs into a crisis. There are some signs that the first cracks in private credit are showing. As more capital flows into private credit and new players enter the space, there's growing worry that underwriting standards have become more relaxed.
So you got a lot of smaller funds developing. That's driving a lot of competition within the private credit funds and does run the risk of causing a flight to the bottom. Bad lenders with weak underwriting force good lenders with better underwriting to lower their standards just to keep up and maintain their business.
There's also concern that leverage is now rising, both within private credit firms, which are borrowing money to juice returns or come up with liquidity, and among the companies they finance. Some on Wall Street see parallels to the run-up to the 2008 financial crisis, where financial institutions increased their leverage to amplify returns.
There has been a lot of lending and increase in leverage among non-financial corps, particularly those that have been purchased by private equity firms that are using private credit as a source of funding.
You've also seen a growing number of private credit borrowers taking on new debt in the form of payment-in-kind loans, or PIKs. A PIK typically allows a borrower to pile on more debt instead of paying back the interest they owe on their loans. Some on Wall Street consider PIKs to be a kind of shadow default signal that increases the risks of bankruptcies in the future.
There's also the concerns of reaching sort of systemically important businesses like insurance companies and others. Their involvement in private credit is as investors, and so there is another source of potential concern if we think that the leverage is too high.
Banks are a major source of funding for non-bank lenders, meaning that stress there could ripple into the broader economy. Commercial loans to non-bank financial institutions reached $1.14 trillion in March 2025. Bank loans made to non-bank financials were the single fastest growing category, rising 26% every year from 2012.
So far, the bank regulators who have been looking into this have deemed that the leverage levels sort of coming from the banks lending to the private credit funds are at acceptable levels. Now, of course, that relies on all of the underlying information being correct about the values of these loans in these private credit funds portfolios. And so that's, I think, where there's some potential for concern. Are these loans and these portfolios actually healthy, or are they distressed and we're kind of masking the distress?
All of that being said, some of the recent anxiety about private credit may be either early or misplaced. In late 2025, the high-profile collapses of auto companies First Brands and Tricolor Holdings, both of which relied on complex borrowing arrangements that included private debt, sent Wall Street into a panic.
When you see one cockroach, there's probably more.
In December 2025, U.S. prosecutors charged top Tricolor executives with fraud, alleging that they directed employees to alter company records to make delinquent loans appear eligible as collateral. But the banks that lend to the private credit industry have called these cases isolated, and others on Wall Street have said that such wrongdoing is possible at any company, including those that rely on traditional sources of funding.
If we do see signs of trouble, will that be contained to that market and those sophisticated investors, or are they going to ripple out and affect a bunch of banks, a bunch of insurance companies, and retail investors as well?